Welcome to the Physician's Guide to Financial Wellness, the podcast dedicated to helping physicians in Michigan turn their professional success into financial success while enjoying life along the way. And now, here are your hosts, Andrew Mushbaugh and Trent DeBruin.
Hi everyone, and welcome to another episode of the Physician's Guide to Financial Wellness. This is Trent DeBruin, and I'm joined, as always, by my co-host, Andrew Mushbaugh. And for today's podcast, we're going to do something a little different. This is our first ever Mailbag episode, so we're going to answer some of the questions we've received over the past several months. And I know we always mention this at the end of the show, but we really do love to hear from our listeners. So if you have questions you'd like us to answer on future Mailbag episodes, please feel free to send them to us at info@mdwmllc.com. And Andrew, I guess I should clarify that these are personal finance questions we're answering here, not some of the general life questions that are probably on your mind right now, like, will Notre Dame or Michigan be better in football this year? Or will Grant ever sleep past 6 a.m.? Or why is The Office no longer on Netflix?
Yeah, well, obviously because we way too short of an episode. Michigan will be better than Notre Dame. Grant better start sleeping past 6 a.m. And it's way too soon to start discussing The Office not being on Netflix.
Yeah, I guess that would have been a shorter podcast episode outside of our Michigan versus Notre Dame debates.
Yeah, we'll keep those debates offline.
So before we dive into it, we want to give you a quick overview of the questions we'll be answering. And for today's episode, there are 3 of them. Number 1 is, I'm not sure if I'm doing everything I can to minimize taxes. Is there a way I can check on this, or what should I be considering? Number 2 is, I've built up quite a bit of cash in my savings account that I don't know what to do with, and I'm nervous about investing now after the market's gone up. And number 3 is, I like the idea of passive income, and I've heard real estate is the best way to do this. So what are your thoughts there? So all great questions, and Andrew, why don't you kick things off by taking the first one?
Sure. So as you mentioned, the first question is around taxes. And specifically, I'm not sure if I'm doing everything I can to minimize taxes. Is there a way that I can check this, or what should I be considering? And this is a common one that we hear because taxes tend to be a hot topic for people, and everyone wants to pay less in taxes, or at least avoid paying more than they have to. And we should mention that when it comes to taxes, people sometimes believe that there's a silver bullet out there or some easy way to avoid paying a significant amount in taxes. Unfortunately, the reality is that we all have limits on our ability to reduce our taxes, and there isn't a magic formula that will allow you to avoid them. That being said, for each person, there is a list of things that you can do to lower your taxes based on your specific situation. So I'll walk through a few of the most common ones so you can check whether you're taking advantage of them. And I'll start with the people who are still working, so we'll look at the situation for the typical employed physician. So the first place to look is your employer's retirement plan. Different employers offer different retirement savings plans, whether that's a 403b, 401k, 457b, etc. And these plans give you the ability to save for retirement while also saving on taxes at the same time by making pre-tax contributions. And different physicians have different amounts of saving space in their employer retirement plans based on their age and the specific plans offered by their employer. But using these is one of the best ways to lower your tax bill. And as a side note here, physicians who earn side income outside of their main jobs also have even more potential tax advantage saving space here, since they have the ability to set up a business and a retirement plan for their side income and potentially save even more on taxes by saving money to an additional tax advantage retirement plan. And outside of retirement plans, another area to look at within your employer benefits is a health savings account or a flexible spending account. Both an HSA and an FSA allow you to receive a tax deduction by contributing to them. And you can then use that money tax-free to pay for either out-of-pocket healthcare costs in the case of a health savings account or a healthcare flexible spending account, or childcare costs in the case of a dependent care flexible spending account. And one thing to note here is that flexible spending accounts are use it or lose it accounts, where you have to use the money within the calendar year, or at least within the grace period window, whereas a health savings account has more flexibility since you can roll unused money into future years. And because the contributions you make to your health savings account can be used for future years, they also offer the ability to invest your contributions to the account, similar to how you would invest your 401k or 403b retirement plan, which allows your money and savings to grow even more over time. Now, switching gears from employer benefits, for those people saving for college, another way to save on taxes, at least in Michigan, is by contributing to a 529 college savings plan. In Michigan, you can receive a state income tax deduction for annual contributions up to $10,000, and anyone can contribute, parents, grandparents, etc. However, the only person that is eligible for the tax deduction is the person or household who actually contributes to the account. So if you have a grandparent who lives in another state and they make a contribution to a Michigan 529 plan on your child's behalf, neither you or the grandparent will receive any initial tax benefit from that contribution. And another way to potentially save on taxes is by giving money to charity. Now, it's worth noting that during your working years, you will only receive the tax benefit for charitable contributions if you itemize your deductions for tax purposes. And since most people take the standard deduction rather than itemizing their deductions, charitable giving may not always result in you actually saving on taxes. However, if you are one of those people who itemizes, making qualified charitable donations is a great way to save on taxes. We walked through the most tax-efficient strategies for giving to charity in episode 23, which is a great starting point if you're interested in taking a deeper dive and optimizing the way that you give to charity. And the last item on the checklist we want to mention is a bit more nuanced, but it's relevant if you have a taxable investment account, also known as an individual account or a brokerage account. But if you have one of those accounts, you can do something called tax loss harvesting. Tax loss harvesting is a way to make lemonade out of lemons during the temporary but inevitable periods where the stock market is temporarily down. And from a high level, tax loss harvesting is selling an investment that is temporarily at a loss, aka worth less today than what you bought it at for tax purposes. The tax benefit of doing this is that you can use those losses to offset any taxable gains you have from other investments that you sold. And if the losses exceed any taxable gains you had in a given year, you're able to deduct up to $3,000 of losses on your tax return that you can offset other taxable income you have. On top of that, any losses you have above the $3,000 limit of what you can deduct in a given year can be carried forward into future years. And there are some nuances you'll need to understand in order to fully capture the benefits from tax loss harvesting. So you want to fully understand all the rules and consult with a qualified tax professional before implementing this on your own. So I know that was a bigger picture overview of the different strategies you can take advantage of during your working years. And for those interested in a little more detail about the strategies we mentioned, we have an entire episode, episode 3, devoted to ways you can save on taxes as an employed physician. And now switching gears a bit, the other distinct period to consider with tax planning is in retirement. And one of the things we always mention here is that in retirement, rather than focusing on paying as little in taxes in any one particular year, you want to focus on the entire retirement time horizon and minimizing your lifetime tax bill throughout the course of your overall retirement. And the opportunities and strategies are much different here than during your working years. So I'll touch on a few of the most common ones to consider. And there are a lot of changes in retirement, but one of the biggest changes is the shift from receiving a paycheck and saving to your investment accounts to not receiving a paycheck and withdrawing from your investment accounts. Because of this, you have less options for tax deductions, like saving to your employer retirement accounts, but also will likely be in a lower tax bracket since you no longer have a steady paycheck coming in that is all taxable. And with the responsibility of creating that monthly paycheck shifting to you in retirement, it creates a lot more flexibility and planning opportunities to save on taxes. This is where you can be strategic with the way you utilize your income sources, like Social Security, and withdrawal from your retirement accounts based on the different tax treatment they all have. One of the biggest opportunities is something called Roth conversions, where you convert or move money from your pre-tax accounts, like IRAs, to Roth accounts, like Roth IRAs. You pay taxes on the money you convert, but once it's in the Roth IRA account, you never pay taxes on the growth or any money you withdraw from the account in the future. So in simple terms, the reason you take advantage of Roth conversions is to smooth out your lifetime tax bill. Effectively, you are comparing your tax bracket today to where you expect it to be in the future and are proactively planning how to smooth out any jumps. In other words, you pay more in taxes today than you'd otherwise have to avoid having any large, potentially unexpected tax jumps in the future when you are required to start withdrawing from your pre-tax retirement accounts at age 72. So one of the things you can do with Roth conversions is to, quote unquote, fill up tax buckets. For example, making these Roth conversions up to the 22 or 24% tax bracket during your early years of retirement to avoid potentially having to pay taxes at the 32% tax bracket in the future. Along with this, you can be smart about how you withdraw from your different investment accounts, including your taxable account, to minimize the amount of taxable income you generate to meet your living expenses, which allows even more space for additional Roth conversions. Another way to create even more space for Roth conversions during those early years of retirement is understand the optimal strategy for claiming your Social Security benefits. Because up to 85% of your Social Security benefits are taxable to you, this lowers the amount of space available to fill up those various tax brackets through Roth conversions. And there's no one-size-fits-all solution with Social Security, but there are several tax benefits to delaying collecting Social Security until age 70. And in addition to all the different strategies around how you withdraw from your accounts and create your retirement paycheck, there are additional options in retirement when it comes to charitable giving and reducing your tax bill there. The biggest one to mention is qualified charitable distributions, which can be made starting at age 70.5. A qualified charitable distribution is when you donate money directly from your pre-tax IRA account to charity. And these allow you to avoid paying taxes on the money distributed from your pre-tax IRA, since it went directly to charity. And once you're 72 and have to start making those required distributions from your pre-tax IRAs, you can make up to $100,000 in qualified charitable distributions that offset the amount you're required to take out of your pre-tax IRAs. So that was a quick, or maybe not so quick, snapshot of some of the things to consider if you're looking at how to pay less in taxes in retirement. But similar to tax planning while working, we also have a dedicated podcast episode on this topic, episode 15, on how to minimize your tax in retirement, where we go much more in depth. So please check that out if you're interested. All right, I think we touched on enough with taxes in that first question, which we can thank the IRS for making the tax code so intuitive and easy to play around, right?
Yeah, the IRS just wants to help people minimize the amount of taxes they pay, right?
Yeah, exactly.
So now we'll move on to question number 2, which is, I've built up quite a bit of cash in my savings account that I don't know what to do with, and I'm nervous about investing it now that the market has gone up. And this is one we actually see across the board in terms of different age groups. It's common for physicians in their initial years as an attending, where they have that jump in income once they finish training, but haven't changed their lifestyle dramatically compared to residency or fellowship. So with a higher salary, the money starts to really accumulate in the bank after a few years. But we also see it with physicians later in their careers, where they're contributing a certain amount to their employer's retirement accounts each year, but even beyond that, they have extra money that's accumulating. And at a certain point, it can get a little paralyzing where you should probably be doing something else with the money rather than earning that generous 0.01% interest rate that most banks are paying these days. But the dollar values are high enough that you also don't want to make a mistake with your hard-earned money. But regardless of the specifics of your situation, the first step in tackling this question is to start with thinking about what the money is ultimately for. Is this money you're planning to use within the next year or two for a home purchase or renovations? Or are you not planning to use it until years down the road when you're in retirement? And the reason you want to think about this is because you're going to manage and invest money differently depending on the time horizon. When you invest money, you expect to earn a higher return than just keeping it in the bank. However, when it comes to investing, those higher returns are never guaranteed, and especially not over shorter periods of time. For example, while investing in the stock market has had a historical average return of around 10% per year, it hasn't been a consistent 10% each year. There are years when the market's been up 30% and years when it's been down 20%. Knowing this, if you're planning to use the money in the short term, you wouldn't want to run the risk that you have bad timing with when you invest, and the market experiences a temporary decline and you have to sell your investments at a loss to use the money. In this situation, the potential higher return from investing the money isn't worth the risk, and it probably makes sense to just keep the money in the bank where it won't give you much of a return, but you also know it's going to be worth the same amount when you need to take it out and actually use it. On the other hand, if you're not planning to use the money anytime soon and are investing it for retirement, whether that's 5 years from now or 25 years from now, you have a longer time horizon and the ability to take on more risk with how you invest the money, knowing that you can ride out the temporary declines of the stock market over the years without needing to withdraw the money to use it to fund your lifestyle or pay for goals. Now, the exact mix of stocks and bonds, in other words, how much risk you take on with your investments, will depend on the specifics of your situation, including your goals, time horizon, and investment temperament. But that's how to think about it. So that gives a general overview of how to approach cash you have building up in the bank. But the other part of the question is about timing of when to invest, especially after the market has gone up a lot, as it has in recent years. And here, it also comes back to time horizon and having the right perspective. If you look at the history of the stock market, there have been countless points along the way that, at the time, were quote-unquote all-time highs, but in hindsight are much lower than where we are now, and you would have been extremely happy to be able to invest at that level. So while there's no guarantee that this will persist in the future, the long-term trend has clearly been upward, where new all-time highs have been reached decade after decade. That being said, it's never a straight line with investing, and another feature of the stock market is periodic declines along the way. To give some perspective, on average, there's a peak-to-trough decline of between 10 to 15% each year, a pullback of 20% every 5 years or so, and a decline of 30% or more every 10 years on average. So it's not always a smooth ride, and this volatility along the way is also the reason the stock market has historically produced higher returns than investing in bonds or keeping cash in the bank, since it's riskier and the higher returns are the investor's compensation for bearing that risk or volatility year after year. So looking at things today with the stock market near all-time highs and having risen a lot over the past decade, it can be stressful to think about investing cash that's been sitting on the sidelines after having, quote, missed out in recent years. And while it's certainly possible that another temporary decline is right around the corner, it's impossible for anyone to predict in advance when these will happen or how significant they'll be. But going back to the idea of time horizon, the longer your time horizon is, the less your timing matters with investing. If you do invest immediately ahead of the next correction, but don't need the money anytime soon, you have time to ride it out and wait for the subsequent recovery. And while there's no guarantee that things going forward will be the same as the past, the longer your time horizon, the more likely it is that your investments will be worth more in the future than they are today. That being said, even if you fully embrace this mentality and perspective, the idea of taking a pile of money and investing it all at once can be a little daunting. So if you do have money that you've decided to invest, rather than doing it all as a lump sum, one option is to instead ease in by doing some now and the rest on a set schedule, such as X dollars each month or every other month until all of the money is invested. This approach is called dollar cost averaging, and it can not only feel better psychologically, but it also hedges against the risk that you have bad timing with your initial investment and invest everything immediately ahead of a market pullback. With dollar cost averaging, if the market goes up after your initial investment, at least you were able to invest some at the lower initial price, while if the market goes down, at least you're able to invest the remaining money at a lower price. So hopefully that's some helpful perspective, not only about how to think about money that's building up in the bank, but also how to go about actually investing it if you decide that's the best use for the money based on your goals and your time horizon.
Yeah, I'm still waiting for that bell to come out that rings when it's the right time to buy or sell.
Yeah, me too. Let me know if you ever find it.
All right, will do. All right, the last question we're going to cover is about real estate. And the question is, I like the idea of passive income, and I've heard real estate is the best way to do this. So what are your thoughts? And now, generally speaking, passive income and real estate tend to be popular items, especially in the physician community, and especially for many people with an early financial independence goal. And it makes sense that this is popular because who doesn't like the idea of passive income and getting paid for something that theoretically doesn't require any ongoing work or effort? There isn't a right or wrong answer here. However, there are often misconceptions and things people often overlook when considering real estate as an investment, which are important to understand before thinking real estate is a free pass for passive income. And before deciding on investing in real estate or any other investment, the starting point is thinking about the best use of your money and what its purpose is. With real estate, the idea is you're investing money in it because you expect to earn a return on that investment and eventually receive a monthly quote-unquote passive income stream. So it makes sense to compare using money to invest in real estate relative to the other available investments or uses of money, of which the most common one is the stock market. When you invest in real estate, you earn a return on your investment in two ways. Number one, through the value of the real estate increasing, price appreciation, and number two, through any rent or income you earn from the real estate, or rental payments. And similarly, when you invest in the stock market, you also earn a return on your investments in two ways. Price appreciation, or the value of your investments increasing, and number two, dividends, or money that's paid to you each quarter or year from the stocks you own, which basically is the equivalent of rent you're collecting. And dividends are something people don't always appreciate when it comes to investing in the stock market, but they're significant and add up over time. Historically, a large portion of the stock market's returns have come from dividends and reinvesting them. The average dividend yield of the stock market from the S&P 500 over time has been roughly 2%. For example, for each $100,000 in stocks you've owned, you've historically received roughly $2,000 in dividends or rent payments each year. So high level, real estate and the stock market are similar as investments in terms of what things make up your return as an investor. But another aspect to consider is the cost of owning the investments, both direct and indirect costs. When it comes to real estate, it isn't free to own it year after year once you purchased it, and there are costs involved. Some of these direct costs include property taxes, the interest you'll pay on the mortgage, and the periodic costs of maintenance or repairs. These are just a few examples, but these carrying costs for real estate can be large and ultimately lower your overall rate of return on your money. On the other hand, the ongoing costs of investing in the stock market are really quite low. You can own a diversified index fund or ETFs from Vanguard, which have expense ratios, which is the amount you pay to the investment company each year, as low as 0.1% or even less, and minimal to no trading cost. So investing in the stock market has become more and more affordable over the years. Another dimension to consider when comparing real estate to the other potential investments is the effort involved, aka the indirect costs. On the front end, there's more work because the process of buying real estate is more complicated than the process of investing in the stock market. But on an ongoing basis is where there's even more of a difference. With investing in the stock market, you have to be smart about how you manage your investments on an ongoing basis, including using asset placement, rebalancing your portfolio as needed, doing tax loss harvesting, etc. But with investing in real estate, once you buy the property, in addition to being an investor, you also become a landlord. So you're the one responsible for finding tenants, collecting rent each month, finding new tenants if yours leave, fixing things that break, or making improvements that need to be made. When people think of passive income, they don't always think of these aspects and the headaches and time involved with being a landlord for your properties. And yes, you can outsource this work by hiring a property management company, but this costs money, typically around 10% of monthly rent, which is another direct cost and further reduces your investment return. So there's a trade-off involved, and you have to choose what's most important. So what about the overall return from investing in real estate versus some of the alternatives like investing in the stock market? Well, it's tough to give an apples to apples comparison because real estate tends to be so local, where your return is going to vary significantly depending on what city or local market you're looking at. But just to give some general perspective, U.S. home prices have historically increased in the low single digits each year. So add that to the rental income you earn from the property and subtract those carrying costs, property taxes, mortgage interest, etc., and maintenance and repairs to get your overall return. By comparison, investing in the stock market has historically given you about a 10% annual return. And another reason why it's so hard to give an apples-to-apples comparison is because owning real estate makes your investments less diversified, since a large amount of your investment portfolio is tied to a single asset or property. And what happens with it, whereas if you own a diversified stock portfolio, you can spread your investment risk across thousands of stocks all across the globe. And outside of the purely financial aspects, another allure of real estate investment is the idea of a consistent monthly stream of cash flow being easier to digest when thinking through what retirement will look like from a monthly basis when you're no longer receiving a paycheck. The other allure is that unlike the stock market, you typically don't see large swings in daily, monthly, or yearly value of your real estate investment. This creates more of a mental framework that real estate can be quote-unquote safer or more consistent from a passive income perspective. So overall, it's easy to see why real estate is popular as a passive income source, but just make sure you understand the pros and cons of it compared to some of your other options for investing. And one of the biggest points we want to make is that for the vast majority of people, you can accomplish the same goals with a lot less effort by simply investing in a well-diversified stock and bond portfolio and holding it over the long term. This type of investing can really be considered passive income source itself since your money is working for you without any effort on your part and providing income in the form of dividends and interest each quarter or each year And when you eventually reach retirement or financial independence, you can simply withdraw money to fund your lifestyle and create a consistent monthly paycheck from those investments. Yes, investing in stocks and bonds is definitely less tangible than owning actual physical real estate. You're going to experience larger price swings over time. But we think that from a bigger picture perspective, what matters most is accomplishing your goals in the easiest, most efficient way possible. So just make sure you're looking at the full picture when considering your different options and weighing both the pros and the cons.
Yeah, absolutely. That focus on the big picture is key when it comes to managing your finances. Well, that covers the 3 questions we wanted to answer today, and hopefully that provided some useful perspective. Thank you again to everyone who's provided some great questions for us to answer, and we're planning to do some future mailbag episodes as well, so please keep those questions coming. As always, you can find the show notes at mdwmllc.com/podcast, and you can reach us through email at info@mdwmllc.com. Thanks for joining us for another episode, and we'll look forward to talking to you again soon.
Want even more ideas, tools, and resources on how to make smart financial decisions? Check out the resources section of MD Wealth Management's website at mdwmllc.com, where you'll find additional knowledge and insight from Michigan physicians, including a blog, ebook, and one-page guides. While there, you can also schedule a 15-minute conversation with Andrew and Trent to learn more about what it means to work with the firm and how they serve physicians. If you've enjoyed the content, please leave a review on iTunes and share with your friends and colleagues. Thanks so much for listening. Andrew Mushbaugh and Trent DeBruin are certified financial planners, principals, and co-founders of MD Wealth Management, a registered investment advisory firm in the state of Michigan. All opinions shared in the show are for general information and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future returns. Please consult with your legal advisor, your tax advisor, or your financial advisor before making any decisions.